Meantime, we got an upgrade for AT&T. That's our call of the day. SVB MoffettNathanson raising the stock from underperform to a market perform. While analysts point out they don't see much upside for the stock, they do say shares have already priced in the tough environment. For more, let's bring in Craig Moffett, the man behind the call. Craig, great to have you on. I think the last time we had you on, it was something like along the lines of what's wrong with AT&T. You laid out all these reasons why you didn't like the stock at all, and here you are, you're less bearish. And that's simply because it's fairly valued now?
Yeah, look, I'm less bearish because it's less expensive. It was, I think, if I recall, $23 at the time. Now it's 15 and change. And so it's hard to have the same level of bearishness at this valuation.
You do call into question, though, it's cash figures, right? It's cash flow figures.
Yeah, look, to be fair, I'm not the only one, but this is a company that significantly lowered its guidance last year for free cash flow, and the proof is in the pudding, right? For all the free cash flow that they said they generated, their net debt actually rose a little bit last year instead of fell without any acquisitions. But leaving aside that issue, I mean, this is a company that is struggling, right? We've got it doing 220 in earnings this year. By 2027, we've got it doing just over 2. So this is not a growth business. It's a tough industry, and it's not something I think we said in the note. We're not optimists. You shouldn't mistake this upgrade for suddenly we think there are green shoots and things are getting better. It's simply that the market has appropriately priced in that what you get when you get AT&T.
Craig, first, congrats, because you really have been on the other side of this trade, and it's kind of cool to see, taking 2 bites of this cherry. I'm long AT&T and was on the wrong side of the trade on the way down. The competitive and predatory nature of the industry, throwing in, obviously, scrambling cable companies, too. T-Mobile has crushed everybody. Yes. And should we read through that the best days for T-Mobile are over? And I know we're talking about AT&T here, but I look at the entire industry, and yes, the glass is half full at this point. But I continue to think T-Mobile is going to eat their lunch.
Yeah, it's a good point. They absolutely will, I think. The question there is, are expectations for T-Mobile now also at a point where it looks like it's roughly a market performer? I sat on a buy rating on T-Mobile for what was essentially a decade and downgraded them about, I want to say, 4 months ago, not because I think they're any less good a company, but because finally expectations had caught up. And again, it's, T-Mobile's the best house in a bad neighborhood, but that's fine if the neighborhood is declining. If the neighborhood catches on fire, even the best house is not going to be a place where you necessarily want to be. And so my enthusiasm for T-Mobile has cooled because expectations have come up, the price has come up, and the neighborhood has gotten even worse.
Since you're less bearish on AT&T, Craig, is the possibility of it cutting its dividend in the rearview mirror, or is that still a possibility given your doubts about free cash flow?
Always a possibility, unfortunately. I don't think it's an imminent possibility. We started saying we thought they'd cut the dividend I want to say 5 years ago or so, and it finally culminated in the dividend cut that they took as they were spinning off the Warner Media business. I think now it's probably safe for the time being, but ultimately, if you're a business that's got as much debt as AT&T does, and you're not growing, and they're not, then ultimately where that takes you, particularly in a rising rate environment like we're in, and they have to refinance their debt, is it takes you eventually to having to cut the dividend. And to be clear, the pressure on the dividend at AT&T, and this is true for not just AT&T, but also Verizon even, is not that they don't generate enough cash to pay the dividend. It's that they don't generate enough cash to meaningfully delever, and their leverage ratios are already higher than what would be warranted for their credit ratings. So ultimately, the pressure point is something's got to give, and usually that is that they have to reduce the dividend in order to delever faster.